Welcome to the presentation on risk management applications of option strategies. So in this presentation we will talk about a long call, short call, long put, short put, and for these positions we need to understand how to draw the payoff and profit diagrams. We need to understand what's the maximum possible profit, maximum loss, what's the break-even point, and what is the investor outlook when he invests in one of these. We will then talk about a covered call and a protective put. Let's start with the simplest one, which is a long call. And to understand this well, we will do this through an example. Let's say that you go long on a call option, and to go long at time 0 you pay an option premium of $3, and let's say that the strike price is 25. So you, by paying this $3, have the right to buy the underlying for 25, and we want to draw now the payoff and the profit for the long call. So this axis now represents the different possible prices of the underlying stock at maturity. So time t represents maturity. The payoff for a long call, which is what you've seen before, is as follows. So if this is our exercise price of 25, then the payoff looks like this. And just as a quick refresher, if the stock price at maturity ends up less than the strike price, then the payoff is 0. But if the stock price at maturity is more than the strike price, then the call option is in the money, so you have this payoff. If the stock price ended up at 30, your payoff was 30 minus 25, which is 5. So this is your payoff diagram. But what about the profit diagram? Remember, you paid an option premium of 3. So to come up with your profit diagram, you simply need to subtract 3 from the payoff. So it is straightforward. You can simply have something that looks like this. So this is your profit diagram for a long call. What is your maximum possible profit? The maximum possible profit is infinite, because if the stock price is very high, then the profit will be very high. So there is no upper bound on the profit. So we can just simplistically say that that's infinite. What's our maximum loss in this scenario? The maximum loss is the amount that we paid for the option. So if the option ends up out of the money, then our loss is simply $3. So this $3 loss is our maximum possible loss, and this effectively is C0, which is the option premium. So the C0 is the general term. If you had paid $4 for this option, then your maximum possible loss would have been $4. Break-even point is this point right here. So that's your break-even point, and you can see that the break-even point is equal to, in our example, when the stock price is at 28. So when the stock price is at 28, then our payoff is 3. But since we had spent $3 on the option, so our profit is 0. Profit 0 means that's our break-even point. And how do we get the 28 number? What we have simply done is said it's the strike price plus C0. So in our example, X was 25 plus C0 was 3. So that's how we got the 28. So this is our long call. Why would somebody get into this position? If an investor is bullish on the underlying stock, he can then invest or buy the call option, go long on the call option, and he will make money if the stock price goes up. If the stock price doesn't go up, his loss will simply be the money that has been spent on the option. Next we'll talk about a short call, and again let's start by doing the payoff diagram for the short call. The payoff diagram, as you've seen in earlier reading, the payoff diagram for a short call is simply the mirror image of the long call. So if this is our strike price of 25, then again we will assume that C0 is equal to 3 and X is equal to 25. Now, however, since this is a short call, that means you made $3 by writing or selling the call. And this means that you now have an obligation that if the long party comes and exercises the option, then obviously you will have to oblige. So if the stock price ends up being $30 at expiration, then your payoff is -5, because you will have the long party will have the right to buy from you for 25. You will have to get the stock from the market at 30 and deliver at 25. So your loss here is -5. So this is the payoff for the short call. What does the profit diagram look like? The profit diagram, however, will look something like this. So this is the profit for a short call. Notice that if the option ends up out of the money, that means the long will not exercise, and you as the writer of the call or the short position, you simply make your $3, which is the option premium, and you are happy with that. So the maximum possible profit is 3, which is the option premium that you charged. What is the maximum possible loss? The maximum possible loss is infinite, because if the stock price keeps going up, your loss keeps building. So there is no limit to the loss. So that's why we say that maximum loss is infinite. What's the break-even point? That's the break-even point. And notice that in our example, the break-even point is 28. Why? Because when the stock price is equal to 28, notice that the payoff for the short call is -3, but $3 is how much you got when you sold the option. So that 28 is our break-even point. So break-even in our example is 28. How did we get 28? Simply it is the strike price plus C0. So in our example, that is 25 plus 3, which is equal to 28. So that is our break-even point. Why would you take a short call position? Basically, if you are bearish on the stock. So if you believe that the stock, let's say when you issued or when you wrote this call option, let's say that the stock was at 25, and you felt that the stock will either remain there or maybe go down. If that view turns out to be correct, then you can simply make your $3 option premium. However, if you turn out to be wrong, then you can lose a lot of money. So this is clearly a very risky strategy. Long put. So remember, a put is the right to sell. So the payoff for a long put is as follows. Again, let's just use some simple numbers. Let's say that we have a strike price of 25 and a put that you initially bought for $3. So the payoff diagram again is like what you've seen before. So this is the payoff for a long put. If the underlying stock ends up with a price of more than 25 at expiration, then the long put or then the put option is out of the money. However, if the stock price ends up at say let's say this is about $10, then clearly the put is in the money. And what is the payoff? The payoff is going to be 25 minus 10, which is 15. What's the maximum possible payoff? If the stock price comes down to 0, then the maximum possible payoff is 25. So this is our payoff diagram on a long put. What about the profit diagram? Now remember, when you go long on a put, you are paying this $3 premium. So to come up with the profit diagram, you simply subtract 3 from every point on this payoff. So essentially you get another curve, or so you get this thing that is just shifted down by 3. So what is our maximum possible profit now? The maximum possible profit is 22. So 22, how do we get that? It is simply equal to the strike price minus P0. In our example, the strike price is 25, P0 is 3, So our maximum possible profit is 22. What's our maximum possible loss? The maximum possible loss is our option premium, which here is 3. So P0 is the maximum possible loss. What's the break-even point? That's our break-even point. Notice that when the stock price is at 22, then the payoff on the put is 3, but 3 is how much we paid for the put option. So that's our break-even point at 22. And again, how did we get 22? That is simply equal to the strike price minus, so X minus P0. So that is our break-even point for a long put. Why would an investor take a long put position? Basically, if he is bearish on the stock. So if he thinks that the stock price will plummet, then obviously a long put position makes sense, because he can make money when the stock price falls. And if the stock price increases, then his loss is capped or limited at $3, which is the option premium. Now a short put, this is simply a mirror image of the long put. So remember, this was the long put, so the short put will look like this. So this is our payoff for the short put. If this is our exercise price of 25, then our maximum possible loss is, this is actually our maximum payoff is at the minus 25 mark. So that is the payoff diagram. What about the profit diagram? Again, given a strike price of 25 and a value at initiation of the put option equal to 3, this means that now you have sold the put option. Short means that you have sold the put option. So you made $3 when you sold the put option. So essentially then, to come up with a profit diagram, all we need to do is add 3 to every point on the payoff diagram. So you simply shift up by 3. So this now is our profit diagram for a short put. What's the maximum possible profit? Notice that the maximum possible profit is simply the premium that you charged. So the maximum possible profit is 3, which is simply P0. What's the maximum possible loss? The maximum possible loss, notice, is 22. When does that happen? If the stock price actually goes down to 0, then at expiration you need to pay the long party essentially $25. But since you had charged 3 initially, you get that cushion of 3. So your loss actually is 22. So that's this point over here. That's the maximum possible loss. What's the break-even point? Break-even point is right here. In our example, that break-even point is 22. How do we get that point? This point is simply the strike price. So this is simply X minus the premium. So X minus P0. So that is our break-even point for the short put. Now let's talk about the covered call. And the first point that you need to understand about the covered call, that it is a stock plus a short call. We have already talked about a short call. So this is where you have sold a call option, and we talked about this being extremely risky because your loss, there is no limit on how much you can lose. But when we combine it with a stock, then actually this is quite a useful little combination. So let's see how this works. Again, we will understand this through a simple example. Let's say that you buy a stock when the price is 20, and let's say that you also write a call option on the stock with a strike price of 25, and when you write the option, C0 is 3, which means that you have sold the call option for $3. Okay, so now what we are going to look at is what is the value of this overall portfolio at different stock prices, and we will then draw this out, and we will also then need to understand what is the maximum possible profit, maximum loss, and the break-even point. So if the stock goes down to 0, what is your profit or loss on the stock? So you bought it at 20. If the stock goes down to 0, then your loss on the stock is 20. What about the profit or the loss on the short call? And actually I'm going to draw this out while we are talking. So if this is these are now our profit diagrams. So this is ST, this is 25, which is our strike price, and this is 20, which is how much we initially bought the stock for. So if the option premium is 3, then you can think of the payoff on the short call as follows. So the payoff on the short call will be something like this. So it will be, actually this is the profit on the short call. So the maximum possible profit that we can make on the call is $3, which is C0. And then if the stock price ends up above 25, that means that the option is in the money. So then the profit to the short call starts going down. The break-even point for the short call alone is 28. So this is our short call, and this will help us figure out this column. If the stock price is 0, then what is the profit on the short call? It is 3. So what is our total profit for this portfolio, which is the combination of the stock and the short call? We have minus 17. So it's actually a loss. What if the stock price is 10? From 20 we go down to 10. So the loss on the stock is 10. The profit on the short call is still plus 3, because at 10 our call option is still out of the money. So as a short call, you simply made your money on the premium. So our total profit, actually we still have a loss here of minus, so loss of 7. What if the stock price is at 17? Then our loss on the stock is 3. Our profit on the short call is also 3. So our total profit is 0. So as we will see very shortly, the 17 is clearly a break-even point. What if we go beyond the break-even point? So at a stock price of 20, we have 0 profit on the stock. What about our short call? Short call, we still make $3 because the option is still out of the money. So the long will not exercise, and the short simply has his premium of 3. So the total profit now is 3. What about stock price of 25? So now you are very happy because you are actually making money on the stock, and you are making money on the call option. So your total profit is 8. But if the stock price goes above that, you are sort of happy, but you're not more happy, in the sense that if the stock goes up to 30, your profit on the stock now is 10. But what about the profit on the short call? Now if the stock price has gone up to 30, then you are losing money on the short call. How much are you losing? You are losing $2. Why? Because if the underlying is now at 30, then the payoff on the short call is 5. So 30 minus 25 is 5, but the profit is 5 minus 3, which is so actually let me just say that again. So if the stock price goes to 30, then as we have seen earlier, our loss on the call option is 2, and the total profit, which is $10 from the stock and the $2 loss from the short call, leaves us at 8. So this represents our total profit on the covered call. And how can we draw this? Actually, in red I will first just put the profit diagram for the stock itself. So for the stock which you invested in at 20, if the stock remains at 20, then obviously there is no profit from the stock alone. But we have a very simple line that goes like this for our stock. So on the stock the maximum loss is 20 and the gain is infinite. I'm going to simply plug these numbers in right now and then also draw out a graph that shows the short call. So notice that our maximum profit is 8. Notice that our maximum loss here is 17, and notice that our break-even point is also 17. Now let's look at the graph of the covered call. So when the stock price goes down to 0, we have a profit of minus 17. So we are at minus 17. Our break-even point is 17. So we go up like this. So at 17 we break even. Our maximum profit we hit when the stock price is at 25. So when the stock price is 25, we hit our maximum profit here, which is 8. And if the stock price keeps going above 25, then the maximum profit remains 8. So this blue line represents the profit for the covered call, and that blue line is simply a combination of the profit on the short call and the profit slash loss on the stock itself. Now how do you come up with this maximum profit? So from the numbers it's easy, but in terms of the formula that you need to memorize, it's as follows: x minus s naught plus c naught, x minus s naught plus c naught. So x in our example was our exercise price, which was 25. S naught is how much you bought the stock for, which was 20, plus C naught is how much you sold the call option for, which was 3. So notice that 25 minus 20 plus 3 gives you the 8 that we calculated. What's our maximum possible loss? It is simply S naught minus C naught. S naught is how much you bought the stock for, which was 20, minus C naught is how much you sold the call option for, which was 3. So our maximum loss 17. And what's the break-even point? That's also given by S naught minus C naught. So that's 17 and this point right here. So this is our covered call. Why would somebody take on a covered call position? So if you are somewhat bullish on the stock, and if the stock is say currently at 20, and you believe that the stock price will either remain at 20 or go up a little bit, then this is a sensible strategy. Obviously you will not have a huge gain, so you might miss out on a huge bull market where if the stock price keeps going up, your profit is going to be limited at 8. But you have also hedged against, you've also given yourself a cushion when the stock price comes down. So if you invested when the stock was 20 and the stock comes down a little, you still have a cushion because of the $3 that you made by selling the short call. So that option premium gives you a bit of a cushion if the stock price starts coming down. Obviously if the stock price comes down a lot, you still make a loss, but there is this cushion that you have because of the option premium. And now finally let's talk about the protective put, which is a stock plus a long put. Now this is a strategy that, as you will see shortly, allows you to hedge against the stock price falling. And again we will take a simple scenario. Let's say that initially when you buy the stock it's at $30. Let's say that you also buy a put option, so you've gone long with a strike price equal to 25 and you pay $3 for the long put. And we are now going to look at what is our total profit on a protective put, which is the combination of a stock and a put option on that stock. What happens if the stock price is 0? Remember, you bought the stock for 30. So if the stock price comes down to 0, the loss on the stock is 30. What about the profit on the put? Remember, the exercise price is 25, so you make a profit of 25 minus 3, which is 22. So your total profit, actually you make a loss over here of 8. And again, I'm going to use this space to draw the payoff, actually the profit diagram. So here is the profit diagram for the long put. So this is our payoff diagram for the long put, where we have a maximum profit on the long put of 22, which happens if the stock price goes down to 0, and the maximum loss is 3, break-even point is 22. Now back to this table over here. When the stock price is, if the stock price is 20 at expiration, then our loss on the stock is $10. Our profit on the put, when the stock price is 20, then on the put, so stock price is 20, so our profit on the put is 2, and our total profit again is minus 8. And similarly, you can see that if the stock price is 25, then our loss on the stock is 5. Our profit on the put is minus 3. So this is where the stock price is at strike, and remember, we paid $3 for the put, so that represents a loss, and the total loss again is 8. What if the stock price now goes up to 28? Then the loss on the stock is 2. What about the profit on the put? So if the stock price now is at 28, then our loss, so now we are in this region where the put is out of the money, so we are simply making a loss of 3, and the total loss again is 8. When the stock goes up to 33, so now we are in this region. Now we are actually making money on the stock, and in terms of the put option at a price of 33, the put option is out of the money, so our loss on the put is simply 3, which is the premium, and our profit is 0. So 33 represents our break-even point. After 33, we are making money. So if the stock price goes to 35, then our benefit on the stock is 5. The put option is out of the money, so our only loss is the put premium that we paid, and our profit is 2. Now again, in red, I am going to draw the diagram for the stock, and then in blue I will draw the diagram for the overall protective put. So remember, we bought the stock at 30, so that's right here, and this then represents the payoff for the stock. So it goes through 30. If the stock ends up above 30, that means we are making money on the stock. If the stock is below 30, then we are losing money on the stock. And now the payoff for the protective put. When the stock price is 0, notice that our profit is minus 8. So we have a lower limit of minus 8. Our break-even point is 33. So when the stock price is 33, that's when we break even. So the way we can draw this out is as follows. So this is our payoff diagram for the protective put. Notice that our worst possible scenario or maximum loss is 8. Our maximum profit is infinite. So as long as the stock price keeps going up, we get the upside potential. Obviously, we lose out the $3 that we paid for the put, and we can think of that $3 that we paid for the put as an insurance premium, because if the stock starts crashing and going down, the maximum possible loss we will have is 8. If we hadn't bought this put and the stock price goes from 30 down to 0, then our maximum possible loss would have been 30. But because we have this protective put, our maximum loss is 8. What's the break-even point? In our example, the break-even point is 33. Now, in terms of understanding the formulas, once you've understood this example, the formulas will be easy to memorize, but here is what we need to know. The formula for the maximum loss is S naught plus P naught minus X. So notice that in our example, what was S naught? S naught was 30. What was P naught? That is how much we actually paid for the put option. So that was 3. And X was the exercise price, 25. So 33 minus 25 is our maximum possible loss of 8. And the break even point is S naught plus P naught. S naught in our example was 30 plus P naught is how much we spent on the put option, which is 3. So 30 and 3 gives us 33. Now you need to memorize these equations, and you also obviously it will be extremely helpful if you can understand all these profit diagrams. It's not that difficult. You simply need you know what the profit diagram for a stock looks like. That's simple. You've learned what the profit diagram for a long put looks like. The protective put is simply a combination of the two, and if you get hung up with these lines, you can easily just derive this by creating this simple table. But once you've done that, I'd still say that you memorize these formulas, because in the exam you will most probably have questions around what's the maximum possible loss, or what's the break-even point, or what's the maximum profit, and so on. Why would somebody create this portfolio? I hope the answer is rather obvious. If you have a stock, and this happened to me some time ago, when I held a lot of Oracle stock and it was going up, I was happy. But in late 1999 and 2000, that stock started crashing. Now, unfortunately, I didn't have any put option, so the stock, which was doing very well, lost a tremendous amount of value, and I lost a lot of money. If I had a put option, then that would have limited my losses. So the put option is sort of like an insurance premium, where you pay some money for the put option, but then you can limit how much loss you have. So clearly it is a sensible risk management strategy, especially if you are worried about the possibility of the stock going down a lot. That is it. As always, practice very hard. There are several problems at the end of the curriculum reading. Try to do them all, and most of them revolve around finding the maximum possible profit or maximum possible loss and break-even points. You need to understand your covered call, protective put, and then you are in good shape. Please post your comments on YouTube. If you like this video, then click on the like button.